All right. These variances, we'll try to explain this the best that I can. We don't actually teach variance analysis at the community college in our managerial accounting courses, and I haven't taught cost accounting, which is where this is more commonly taught in a number of years. So I'll do my best to kind of work through this. So let's just look at the very first one. Calculate the materials price, quantity, and total material variance. And I've put a little formula in here to kind of help you figure this out. So the price variance is the difference between the actual and budgeted amounts times the actual quantity. And so let's kind of write some of these things in. So the budgeted amount is this thing here, this 12 cents. That's our standard cost. Our budget and standard are the same. It's what we expect to pay. Our actual quantity of output tells us that we actually used 260,000 pounds of materials. The question we need to figure out is what's the actual price, because that's not given to us, and we actually have to calculate that, and we can use this information right here. So it tells us we actually paid $31,500 for $350,000 pounds of raw materials, and that works out to be 9 cents. So the actual price was 9 cents. Our standard was 12 cents. So you should be able to deduce that we're going to have a favorable variance here because of the fact that we paid less, or our inputs cost us less than what we had budgeted. And that price variance is 78,000 favorable. All right, now let's look at this one. I think your book calls this a quantity variance. Sometimes it's referred to as an efficiency variance. In fact, when we turn around and do it with labor, we call it an efficiency variance. It's the same calculation, though. So what in this case, what we're doing, it's just the opposite of what we did here. So in this case, the variable was the price, and we held the quantity constant. We're going to do just the opposite here. We're going to, the quantity is going to be the variable, and we're going to hold the price constant. And the price is 12 cents per pound. That's the standard cost. We know the actual was 260,000 pounds. So the question is we need to figure out is how many pounds should we have used based on our standards. And let me scroll up here and get that information. We produced 12,000 bags of dog food. And this is telling us that I don't know, hold on. Okay, well, so I think the amount we need right here is this 30. So we let's look at our formula again. The actual quantity of input used. So we used 260,000. The budgeted amount allowed. So what this would say is we produced for our actual output. So we produced 12,000 bags, and we should have used 30 pounds per bag. That's a total of 360,000. So we used less than what we anticipated using. This is also a favorable variance. So there's 100,000 pounds difference times 12 cents is 12,000 favorable variance. So then the total materials variance are the two added together, right? So 7,800 favorable price variance plus a 12,000 favorable quantity variance gives us a total favorable variance, and make sure you're showing your work, of 19,800.